Hello friends, welcome to my channel Learning with Z. This is the second video in the series of Introduction to Macroeconomics. We will look at some basic concepts of macroeconomics in this video. Classification of goods. In economics, goods are defined as items that satisfy human wants and provide utility. Goods are classified into two categories: final good and intermediate goods, consumer goods and capital goods. Let's look at each classification in detail. Final goods. By definition, a final good is a commodity that is used by the end user to satisfy current wants or needs. It does not require further processing, which means it has passed the production process and is ready for ultimate use. Depending on who is the end user of the final goods, it's further divided as final consumer goods and final producer goods. Let us look at the features of each category. Final consumer goods have the motive of end consumption. Examples include grocery items like vegetable oil, bread, cheese, butter, shoes, etc. Expenditure is called consumption expenditure. In case of final producer goods, the motive is further production. Examples include machinery, tools, etc. The expenditure here is called investment expenditure. So, the total expenditure on final goods is the sum total of consumption expenditure and investment expenditure. Intermediate goods. By definition, an intermediate good is a good used to produce a final good or a finished produce. Let us look at the features of intermediate goods. These goods undergo further processing in the production. It means a value addition is to be done at each stage of production to produce the final good. It's not yet ready for use by the end consumer. It is used by the producer to produce another good. Expenditure is called intermediate expenditure. Let us take an example. Wood, which is used by furniture company to make sofa. Cotton, which is used by textile industry to make shirt. Sugar, used by bakery industry to make products like cake or bread. Here, wood, cotton and sugar are intermediate goods because they are undergoing further processing in the industry to become final good to be ready to be used by the end consumer. Concept of value addition or gross value addition. Value addition by a producer is equal to value of good produced minus intermediate good expenditure. We know that an intermediate good undergoes value addition to become a final good for end consumption. For example, cotton. Cotton is used by a textile company to make fabric. This fabric is further used by a garment company to make a shirt, and this shirt is further purchased by a retailer for resale. At each stage of textile company, of garment company, and of reseller, value addition happens. When cotton converts into a fabric, value addition happens. When fabric is converted into shirt, value addition happens. And when shirt is put up for resale at a shop, again value addition happens. So value addition can happen in two ways, either production processing or resale. And it is calculated by a formula of value of final goods produced minus the intermediate good expenditure. Let us look at the differences between final and intermediate goods. Final good is ready for final consumption, whereas intermediate goods are not yet ready for final consumption. Final goods, there is no further processing here. Intermediate goods still undergoes production process. Final goods, no value addition. whereas value addition happens in case of intermediate goods. Expenditure by the end consumer in case of final goods is called consumption expenditure. Expenditure by producer in case of intermediate goods is called intermediate expenditure. Motive is end use in case of final goods. Motive is further production in case of intermediate goods. Final goods is a part of national income, whereas intermediate goods is not the part of national income. Now let us look at another classification category, which was consumer goods and capital goods. Let's look at consumer goods first. By definition, consumer goods are goods sold to consumer for their own use or enjoyment and not as a means for further economic production activity. Consumer goods can be classified further as durable goods, non-durable goods, and services. Durable goods are generally those goods which are high in value and can be used for more than a year. Mostly electronics like TV, fridge are durable goods category. Non-durable goods are goods which are relatively lower in value and their life is just less than a year. Examples include kitchen utensils, crockery, clothes, etc. The third category is services, which are for immediate consumption, like services of a teacher or a maid. So here the consumption happens simultaneously as production. So this is the third category of consumer goods. Capital goods. Capital goods are also called as capital or fixed assets. By definition, capital goods are fixed assets that are produced for use by the businesses to create finished goods. This means these goods are used as producer goods and not as consumer goods. They are high in value. They include fixed assets like plant and machinery. They are used over a period of time and is not meant for single time consumption. Its value depreciates over time. For example, a machinery. A machinery has a life of 10 years, 12 years, or 20 years. It depreciates over a period of that amount of time, say 10 years. So it is going to depreciate every year for 10 years. And the value is, let's say, 10 lakhs, 20 lakhs. So the value is really high. And they are meant for further production of finished goods. Let us look at the differences between consumer goods and capital goods. Consumer goods are for direct consumption for satisfaction. Capital goods are used for building further production capacity. Consumer goods are relatively low in value. Capital goods are high in value. Consumer goods are consumer goods for consumption, whereas capital goods are producer goods for further production. Expenditure is consumption expenditure in case of consumer goods, and expenditure is called capital expenditure or investment expenditure in case of capital goods. Consumer goods does not undergo depreciation, whereas capital goods depreciate over a long period of time. Let us look at the components of consumption expenditure. Consumption expenditure is the sum total of household consumption expenditure, government consumption expenditure, and non-profit organization consumption expenditure. All these categories, household, government, and non-profit, are end users. Household does it for personal satisfaction or consumption. Government does it for the welfare. And non-profit organizations like temples, NGOs, etc., they do it for their own welfare purposes, which is again for the society. But all of them does it for consumption and no further production happens here. So they are consumption expenditure. Concept of investment. Investment refers to change in the stock of capital, also known as capital formation. By equation, investment I is equal to change in capital stock K. It is of two types, fixed investment and inventory investment. Fixed investment is change in the stock of fixed assets like machines, whereas inventory investment is change in the stock of inventory, example raw material, work in progress, or finished good. By formula, fixed investment change in fixed investment is calculated by stock of fixed investment, example machines, at the end of the year minus stock of machines at the beginning of the year. For example, at the beginning of the year, a company has 200 machines, and at the end of the year, it has 400 machines. So the change in the machine is 400 minus 200 equals 200. Fixed investment expenditure is of great significance as it helps to increase the production capacity of the final goods, which ultimately increases output and leads to economic growth and prosperity. Inventory investment is the change in the stock of inventory. Example, raw material we take in the formula, stock of raw material at the end of the year minus stock of raw material at the beginning of the year. Suppose a company has 2 lakh units of raw material at the beginning of the year and 3 lakh units of raw material at the end of the year. So difference between 3 lakh and 2 lakh is 1 lakh, which is the change in the stock of inventory or raw material for that company. Uninterrupted supply of raw material will help in smooth production process. Hence, inventory investment expenditure is of great importance. Concept of depreciation. By definition, depreciation in economics is a measure of the amount of value an asset loses from factors such as normal wear and tear, change in technology, or accidental damages. Depreciation happens in case of fixed assets. Fixed assets are generally used over a period of time, like for example, a machinery, which can be used for a life of 10 years, will depreciate over a period of 10 years every year. So at the end of 10 years, a company needs to replace that machinery. Hence, depreciation is also known as consumption of fixed assets or a replacement cost. Provisions are taken out every year by the company to maintain a reserve called as depreciation fund or depreciation reserve so that at the end of the life of that asset, a new asset can be purchased to keep the production process on. Let us take an example of a machinery which was purchased at a value of 5 lakh and has a life expectancy of 5 years. Now, the company would take out depreciation reserve equal to value of fixed asset divided by life of fixed asset. In this case, 5 lakh divided by 5 years, so 1 lakh each year. So every year the company is going to take out 1 lakh and keep it in their depreciation reserve for 5 years so that at the end of 5 years it has 5 lakh and it will use it to purchase a new machinery to keep the production process on. Another important point to be noted is expected obsolescence, which is the part of depreciation fund and not the unexpected obsolescence. Example of unexpected obsolescence includes natural calamities like fire, earthquake, or recession. Another interesting concept in macroeconomics is stock and flow. A stock is a quantity measured at a particular point of time, whereas a flow is a quantity which is measured over a period of time. Stock, for example, 4,000 units of chairs in a factory as of December 2020 is an example of stock. Bank deposit on 31st December 2020 is a stock concept. Number of employees on the first day of the year is a stock concept. Population of a country in a particular day is a stock concept. A flow concept is measured over a period of time. For example, factory produces 400 shares every month. Salary paid to employee every month. Interest paid every year. Speed of a car are all the flow concept. Sectors of economy. There are four sectors in an economy: household sector, producing sector, government sector, and external sector. Household sector is also known as consumer sector, which is also the provider of services or factors of production, namely land, labor, capital, and entrepreneurship. Producing sector is the sector that provides or produces goods and services. They also generate employment and income for the above factors of production in the form of rent, wages, interest, and profit. Government sector. Government sector ensures welfare and safety. It helps in formulating policies and is responsible for economic development. External sector is related to exports and imports and also capital flow between one country and the rest of the world. All these four sectors are interdependent on each other. So, intersectoral flows are important to understand. Each sector of the economy is dependent on the other sector in one or the other way. This interdependence can be categorized as two types of flows, namely real flow and money flow. Real flow is the flow of goods and services, whereas money flow is the flow of money. Let us look at the two-sector economy and the flow in form of real flow and money flow in these two diagrams. If we look at real flow between production sector and household sector, then from production sector, flow of goods and services happens to the household sector. And in return, the household sector provides factors of production like land, labor, capital, and entrepreneurship to the production sector. In case of money flow, the same two-sector economy, factor income will flow from production to household sector in form of rent, wages, interest, and profit for providing factors of production like land, labor, capital, and entrepreneurship. On the other hand, household sector will provide money to the production sector in form of consumption expenditure for the goods and services provided by the production sector. Circular flow of income. Because of the interdependence among the sectors of economy, there happens a real flow of goods and services, which is also called as phase of production, and money flow as income, known as phase of income generation, and expenditure, known as phase of expenditure, happens. That leads to endless circular flow in the economy. We have just seen in this previous slide how between production sector and household sector, the flow of income happens, flow of goods and services happen, and flow of expenditure happens. This is also called as three-phase circular model, which leads to an endless circular flow in the economy. Let us look at another slide which explains the diagrammatic form of circular flow of income. This is the diagrammatic presentation of three-phase circular model for a two-sector economy. The two sectors are production sector and household sector. So, in case of production sector to household sector, production happens for goods and services in production phase, and expenditure happens from household to the production sector in expenditure phase for the goods and services produced. Similarly, in case of household sector to production sector, factor services are provided like land, labor, capital, and entrepreneurship, and in return, production sector provides income which is in the form of rent, wages, interest, and profit. So you can see how this endless circular motion is going on for real and money flow. And this is endless and keeps on going and keeps the economy running. So friends, this is a very important video from the point of view of understanding the basic concepts of classification of goods and circular flow of income in the economy. This provides quick pointers to you for writing the exams too. Go through this video, like it, share and subscribe so that I can share more and more such useful videos for you all. Thank you so much for watching.